Treasury yields continue to climb off those recent lows. Recall just a few days ago, we were talking about 10-year Treasury note yields going to 280 and possibly 2.75. But alas, we've seen a couple of days of pushes higher. We're nearing the midpoint of the December range, which, wait for it, is around 293. Now, 293 isn't a level that we saw between the middle of September and December, so it's kind of odd to be calling that the high point yield that we could reach here on this last move. But certainly we're seeing yields bounce off those lows, but the momentum is picking up, but I think we're going to hit some resistance at that 290, 293 level, and then we'll have to wait and see whether it's going to be data or Fed speak or whatnot, or global events that takes us from there, whether we go back higher and north of 3% or back down and test those lows, because right now the market seems to be, while pushing forward and getting a little bit of momentum, it seems to be running a little bit out of gas. So right now the market trading back up higher yield-wise. And what is that doing to implied volatility? Well, we're going back towards the old range, which is the old expectations, which is the comfort zone that the market has had over the last 3 months. So as you can expect, we're off those elevated levels. Yes, trade tensions are down. The potential that we're seeing in the economy seems to be going by the wayside. Equities are seeing a major rally. So certainly implied volatility is starting to come off in the Treasury sector. Although with this last bit of news with Brexit, which is going to bring me to my final point, I'm not really sure if the market is learning what it should have learned back in June of 2016. And that was when all expectations were that this referendum wasn't going to go through, and that they were going to, the UK was going to vote on whether to leave the European Union, and it was just going to kind of get put on the ballot and poof, gone. And it passed. And all expectations, we saw the markets kind of go wild. We saw volatility go higher. We saw equity markets, bond markets, currency markets, commodity markets, everything went wild for not just a couple of days, but then it was followed up later by Trump's winning election in the U.S., and that just added to the volatility. So it just seems that the market seems to be a little bit, naive here, in a sense that it learned once back in 2016, and it hasn't learned its lesson yet, at least to be prepared for the worst. Not necessarily expecting it, but prepared for it. Today, like I said, equities are rallying, Treasury yields are higher, risk-off trades are outperforming, all really except one, and that's the gold market. We see gold holding above 1250, a level it's been holding at, and that to me is a little bit of a surprise. But it is expected that UK Prime Minister May will continue to be the Prime Minister. Her no confidence vote likely not to go through, although that they still have a whole mess of Brexit coming up, and that is nowhere closer to being resolved. And that is another reason why I think risks should be higher and volatility should be continuing to stay elevated. Given the fact that the Brexit vote doesn't push UK Prime Minister out, it doesn't necessarily mean that the resolution's there. And right now the plan in place, or the pseudo plan in place, isn't one that benefits really anyone in the UK, and it still leaves a lot of loopholes, which means that they could have a no-deal exit, which doesn't do good for anybody in the banking sector, doesn't do anything. Trading with UK doesn't do good with anybody traveling to and from. So there's a lot of what ifs still out there. But like I said, today and the last few days, we're not seeing that risk being priced into the Treasury market. Yields on the rise. We had kind of a mediocre 10-year auction today, which aided in the rising yields. But look out, next week's DECE FOMC will be the it moment for the market. How will Jerome Powell, Fed chair, talk about the future, talk about the first quarter of 2019 and beyond? And that is really what the bond market's looking at. And I think right now it's taking a breather from those push towards lower yields, with the hopes that he'll talk about something a little more hawkish than dovish, and maybe talk about higher yields and higher rates in the months and quarters to come.